This week, the European Commission is expected to lift tight controls on Italy's public spending imposed in 2009 when Rome went above the EU's deficit ceiling of 3% of GDP. Joining me on the line is Ben May, European economist at Capital Economics. Ben, if the European Commission lift tight controls on Italy's public spending, what difference do you think this will make to the Italian economy, which is fighting its longest recession post-war?
Well, I think it would certainly be an encouraging development, and it would probably give the government a bit more scope to do some fiscal policy and perhaps front load some stimulus measures in order to help perhaps bring the economy out of recession. But in the grand scheme of things, it's not going to make a huge difference in the sense that the government is still going to have to gradually lower that budget deficit to maintain credibility in the bond market, and also it will still be under pressure to keep that deficit below the 3% Stability and Growth Pact limit.
Will they look more kindly on other nations who are currently feeling the strain now that they're considering lifting tight controls in Italy?
Possibly, but in the end, I think the reason why they're lifting the controls on Italy largely reflects factors that are going on in Italy. Italy's deficit last year was below the stability and growth target, and I think that's probably the key reason why it's considering lifting these measures. So it doesn't necessarily mean that it's going to do the same for other countries that have much higher budget deficits.
There's speculation easing the strict EU monitoring of Italian public spending will free up resources of up to €12 billion. Do you think this is likely?
It's difficult to know exactly what the size of any boost will be. Certainly that figure has been widely quoted, but other figures have come up with lower numbers. I think in the grand scheme of things that's a fairly small amount of money as a share of Italian GDP. So from that perspective, it's unlikely to transform the outlook for the Italian economy, even if they do essentially boost spending by that kind of amount.
Prime Minister Enrico Letta said exiting the excessive deficit procedure would not have an immediate impact on public finances, but would leave more room next year. What are your thoughts on this?
I think that would be the case in terms of the way the rules are set up. Essentially, next year it might be able to have perhaps a little bit less of a fiscal squeeze than is currently planned, and essentially push those measures back a year or two, which might give the economy a bit of a boost next year. But in the grand scheme of things, I think that the size of any change in fiscal stance is going to be pretty small and is unlikely on its own to drive an economic recovery.
And what can we expect from Italian unemployment data released on Friday and Eurozone unemployment figures released on the same day?
The recent news on the labour market has remained pretty bleak, and given that the Italian economy remains deep in recession and the Eurozone is still contracting too, it's very likely that unemployment both in Italy and the Eurozone as a whole will continue to rise.
That's all for now, but do check out my Commodities Corner interview looking at precious metals, gold, silver and platinum. Goodbye for now.